And for those of you that are buying calls, of course, you want to go a little bit further here. You go to long call on the long call playlist, but also this link here to the optimized long option finder. I mentioned, hey, if I'm only expecting a stock to move up 5 or 6% or so, I'm probably buying at the money. Well, our tool here, the optimized long option finder, will show you that. So we were at 272, right, with Apple in our example. So 5% there, we are going to move up 8-9 points, right? No, that's way off, Mike. Sorry about that, folks. That's way off. Let's pull that up here. I think I'm right. 13. 13. So we're at 272. It moves up 13. We go to 285. Let's call it 286 in the next. Hey, let's go the next month, right? Let's go to December, and I'm going to put about $4,500 into call options. Perfect. Excuse me, a little parched there. What that tool just did, the long option finder, is it calculated, it went out to all available options for Apple, grabbed the current price on the chain, midpoint, and calculate, or ask price, I'm sorry, and calculated which option would give me the best percentage return if the stock hit my expectation on my trading date. Okay? And we see here, we did a 5% movement. $13, moved up to 285, 286, maybe $14. Where are the highest returns? Right at the money. 270, 265. Okay? 275, 260, 280. We're in that range, about a 60% expected return, theoretical value. Does this make logical sense? Yeah. Let's take a look. We put in a price of 286. The first one that comes up is the 19th of December, 270 call. It's 35 days out in time. Now, with my 4,500, I could buy 4 contracts. The price is 10.15, so I'd be 40.60 invested into the trade. And it shows me that on 12.14, this option would be worth theoretically 16.20. Does that track? Yes. 5 days away for expiration, 286 stock price, 270 call for the 19th of December. It's going to be worth about $16. $16 in the money, intrinsic value, but that's a 60% return. Oh, and a comment comes in, well, why wouldn't you buy a weekly? Well, we just talked about that with the time value decay and things of that nature. But this is also based on my expectation, Jim, of what I put in. I just use the default and went a month out. So if I'm expecting the stock to hit 286 on 12/14, why am I not seeing a weekly November call? Because I'm already past it, right? It's already expired, worthless. It made money for me or lost money for me. I targeted the 14th. I could go back and say, yeah, I expect the stock to hit 286 on the 20th. And submit that. Now we're going to start seeing some of those weekly series, the November 28th. And where are we? A little bit deeper out of the money. 285, 280, 713% return, 640% return. But again, that's 5% movement in the next 6 days. That's not what I initially looked at. That's why you didn't see those November series, because I just went the default, Jim, month out. All right. So as I mentioned, if I'm expecting a 4, 5, or 6% movement, I could profit on long calls, but it's not going to be 200, 300, 400% return unless it does it in that shorter time frame, as we mentioned. We picked that out of the money, but this tool shows you which option would give you the best theoretical return. I expect a 10% movement, $27. We go up to $300 per share on Apple. Keep that same 12/14 date. Keep that same 4,500. What options do you think are going to come up with the highest return with a 10% move? It's going to be the out of the monies, right? On the ATM bell curve, paying less extrinsic value on those options. We're looking at now the 290, 295, December 300, 300, 378. Where's the December at the monies? They're still here, but they're not in the top 15 or 20 results because the return's not as high. That's how it arranges it. It shows you which one would give you the best theoretical return. Do the numbers track? I pay $216 for the December 290 call. On the 14th of December, Apple's trading at $300 per share, up a 10% roughly, and my option's worth $10.49. My 290 call with the stock at 300 with 4 days to expirations at $10.49. Yeah, that tracks. right? We're basically intrinsic value with 50 cents of extrinsic value, time value left for 5 days. That's a 386% return. But that's the idea. Based on the move, and you think, hey, if the stock only is going to move up 5 or 6% in this time frame, you're going to be buying at the money. You're going to see 30, 40, 50, 60% returns. Okay. Those higher returns, you're going to be using out of the money options, but you're going to have to be expecting a 10, 12, 15% movement. And this tool will illustrate that for you perfectly. Which option will give you the best bang for the buck? Of course, it works the same way. You know, I went into the long call view here and I put in a 5% gain and a 10% gain. If I put a 5% decline, let's say we go down to $259, we lose $13 on 272. Which put's going to give me the best bang for the buck? The December 275. Where is that? Right at the money with a 5% decrease. And if it goes further, it goes another 13 points down, that $27 or so. We drop down to 245. Am I going to be seeing at the money December options giving me the best return? No, we're going to be out of the money. The 260 at 340. That's the return. When you say, oh, I want to see 200, 300% return on my long calls and my long puts, you're needing that 9, 10, 12, 15% movement in the stock. It's not 5 or 6%. All right, 4 or 5 or 6% movement on your stock in a 14, 20, 30-day period with call options. I mean, if it happens the next day after, I buy a call out to December and Apple jumps up that 5 or 6% tomorrow or on Monday, my apologies, folks. Yes, maybe I'd see 70 or 80, depending on what happened, or a put option, especially if it drops 5 or 6%, implied volatility increases, I might be seeing a 70 or 80%. But if you're expecting these returns, you've seen the articles, I see them, I get the emails, hey, we made 300% return average on our 10 positions traded in the first 3 months. Hey, we bought leverage calls, only put out $5,000, and we've got a 300% return potential on these trades. Yeah, if the stocks they did move 10, 12, or 15%. If they don't, you're not seeing those numbers. Okay? And that's just the way it is. It's the way it works. And this tool will help you illustrate that. Just show it for you, articulate it for you. When you're buying options, your expected return. Hey, the stock needs to move. I know it sounds basic. I know you all know that, but it's the levels of movement that you need. You can't just buy a stock, see a 2 or 3% movement in a 20-day period, buy a call option, expect a 200, 150, 115% return. You're looking at 20 to 30. It moves up 5%. Good normal volatility I'm talking about right now. And of course, if you buy the newsy stock that has increased implied volatility with earnings coming up, what are you going to see? You're going to see a high extrinsic value. You're going to be paying into high implied volatility. Your stock could move 6 or 7%, and you could actually lose money on the trade because you paid too much into it. All right, more of that information you can check out later on. Go to our long call page, go to the long call home, and check on that YouTube playlist. Or, of course, just go to our YouTube channel as we did before. On our playlist there, in addition to the covered calls we talked about, the spread trades, I've got a long call buying, and long calls. And what to expect, when to expect, a profit, high delta call buying for stock replacement. There's a discussion in here on implied volatility somewhere, proper delta to buy. Searching tools for evaluating the options goes back through long option finder that we just discussed as well.